Hi guys, my name is Sarvan Kumar, your economy faculty. Welcome to Rathods IAS. Welcome to the economic weekly of this particular week. Guys, as I promised in the previous classes that we are not only going to cover the current affairs as well as we are also going to look at the static as well. So as a continuation of it, let us look at these week's current affairs, particularly with respect to the economy. See guys, recently we have seen this news article. The goods and services tax revenue in February was 26% higher than the pre-pandemic level at 1,33,026 crores. Now, it's just a basic thing to understand with respect to the level of increase in the GST tax revenue. But before that, as I promised, I am also going to deal with a basic static syllabus with respect to the GST in our classes so that the things will be very clear in your mind. Guys, for economy particularly, you should be very aware, you should be revising both the static as well as current affairs when you are dealing with this. Just remembering that this kind of a revenue got increased in the GST is not going to suffice your preparation. So, revision of the concepts, that too properly, is very much important. So, without any delay, let us try to look at what is this GST and it is all about. Now, before I go to the GST, right, now I would like to tell you the basic difference between a direct tax and an indirect tax. We all know that we do have two types of taxes, like indirect tax and the other one is a direct tax. Now, what is the basic difference? How do we differentiate a direct tax and an indirect tax? As you know, the GST is an indirect tax. Now, how to differentiate between a direct tax and an indirect tax? See guys, I would like to introduce you with the two terms, that is impact of tax and incidence of tax. You have to remember these two keywords. Now, if impact of tax, listen to my words very carefully. If impact of tax and incidence of tax is on the same point, then we call it as a direct tax. If impact of tax and incidence of tax is on multiple points, we call it as indirect tax. See, I know that you haven't understood what is the meaning of impact of tax and incidence of tax. To put it in a layman language for you, impact of tax mean on whom the tax is levied. On whom the tax is levied. And on the other hand, incidence of tax means ultimately who paid the tax. Ultimately who paid the tax. This is the meanings of these terms. Impact of tax means on whom the tax is being levied. Incidence of tax means ultimately who paid the tax to the tax authorities. This is the basic meanings of these two important terms. Now, as I said, if impact of tax and incidence of tax is on the same person, we call it as a direct tax, and if impact of tax and incidence of tax is on the multiple points, we call it as an indirect tax. Now, let us try to understand these things with an example so that the things will be very clear in your mind. As I said in my previous classes, economy will be very easy to understand if you got an example for it, right? So, let us take an example and let us try to understand the difference between the direct tax and indirect tax. Now, imagine this is government. Now, if the government says that those persons who earning an income of 1000 rupees need to pay a tax of 10% out of their income. Now, imagine he is a person. Now, this person is earning an income of 1000 rupees. Now, what the government ordered? Government said that those persons who is earning an income of 1000 rupees comes under the ambit of taxation. They need to pay 10% of their income as income tax to the government. Now, see, on whom the tax is being levied here? On whom the tax is being levied? The tax is being levied on this person. So, impact of tax is on this person. Now, who pays the tax to the government? Ultimately, he himself is going to pay the taxes to the government. So, impact of tax is on the same person, and incidence of the tax ultimately who paid the tax to the government is on the same point. So as I said in the definition, if impact of tax and incidence of the tax is on the same point, we call it as a direct tax. Here in our example, income tax is a direct tax. So he will pay 10% of the 1000, that is 100 rupees to the government. On him the tax is imposed. Ultimately he is the one who is paying the taxes. Now we will have another example of indirect taxes. Say, imagine this is the government. Now this is a bookshop. We aspirants often go to a lot of bookstores these days and we try to purchase different kinds of books. Now imagine he is an UPSC aspirant. Now he wants to purchase a book which is priced at 100 rupees. Now see guys, what the government is going to do is, the government says to the shopkeeper that on every book you sell to your consumers which is priced at 100 rupees, you need to pay me 10% of the tax. You need to pay me 10% of the tax. So impact of tax, on whom the tax is being levied. Impact of tax means on whom the tax is being levied. You need to remember it. Incidence of the tax means ultimately who paid the tax. So impact of tax, on whom the tax is being levied, it is on the shopkeeper. Now what is the scenario? You might have come across this scenario already. See, if you go to the shop, then if you ask the price of the book, the shopkeeper will say it is 100 rupees. And he is also going to collect 10% of the tax from you itself on that particular book. Now instead of paying 100 rupees to the shopkeeper, you will pay 100 rupees plus 10%, that is 10 rupees tax to the government. Ultimately you pay 110 rupees to the shopkeeper. Now what the shopkeeper is going to do, the shopkeeper is going to retain that 100 rupees with him and he is going to pay back that 10 rupees to the government. Now see, on whom the tax is being levied, it is being levied on the shopkeeper. So the impact of tax is on the shopkeeper. But ultimately who paid the tax? Consumer paid the tax indirectly to the government. See, consumer given it to the shopkeeper and shopkeeper given it to the government. So incidence of tax is on this person and impact of tax is on the shopkeeper. So impact of tax is on the shopkeeper, incidence of the tax is on the ultimate consumer. So in such a way, if impact of tax and incidence of the tax is on multiple points, we call it as an indirect tax. If impact of tax and incidence of the tax is on the same points, we call it as a direct tax. So these are the definitions. So impact of tax means on whom the tax is being levied, on this person tax is being levied. Incidence of tax, ultimately who pays the tax? Who paid the tax? The same person paid the tax. So impact of tax and incidence of the tax is on the same persons. Here, on whom the tax is being levied, the government levied it on the shopkeeper. Ultimately who paid the tax? The consumer paid the tax. So we call it as an indirect tax. If incidence of tax and impact of tax is on the multiple points, we call it as an indirect tax. I hope the things are very clear for you right now. Now if somebody asks you, you can clearly express that on the basis of impact of tax and incidence of the tax, we define a direct tax and indirect tax. Right? I hope it is very clear for you. Now with another basic example, let me try to make you understand what is this GST and how it works and how the goods are being taxed before GST. See here, this 10% who is paid by the ultimate consumer, that is aspirants like us, is nothing but an indirect tax. It is like a GST. See, with an example we can understand it very clearly. Now try to understand. See, I'm going to put it very simply for you. Imagine this is a shop. See, now this shop is going to produce some bread. Imagine the value of the bread at this manufacturing unit is 80 rupees. The value of output, the bread is nothing but the output of this particular factory. The bread is the output of this particular factory, and imagine he is the person owner of this particular company or manufacturing company, and he is saying that the value of my output, that is bread, is 80 rupees. Now for our understanding, try to consider that he have purchased a wheat at 20 rupees and he also purchased electricity. At 10 rupees. So cumulatively it is 30. So the value of inputs, input value is here 30 rupees. So try to understand, try to differentiate the things. See, the value of output, that is bread at the manufacturing company, is 80 rupees and the value of inputs is 30 rupees. So to put it simply for you to understand, this manufacturer have took an inputs worth of 30 rupees and added a value of 50 and ultimately made the output value as 80. So the value added here can be simply written as value added by the manufacturer is equal to output minus intermediate consumption. So what is this intermediate consumption here? It is nothing but the inputs taken by the manufacturer. What is the output here? That is nothing but the bread. So output is 80 rupees minus intermediate consumption is 30. So cumulatively we got, what is the remainder here? 50. 50 rupees is the value added by the manufacturer for the inputs that he have taken priced at 30 rupees. Right? I hope it is very clear. Now comes the next question. Okay sir, it is very clear for us right now how this 50 rupees is added. Now what is this 50 rupees is all about? Why only 50 rupees? How it is added? How it is added to the input? Now let us try to understand with another example. See why this 50 rupees is added and how it is added. See, in order to manufacture that bread in that particular bread manufacturing company, that owner need to employ some people, right? For that he needs to pay salary for them. Imagine we call it as compensation to employees. Compensation to the employees. It is nothing but salary. The compensation to the employees is nothing but salary. Imagine the manufacturer is paying it as 10 rupees per person. Now, for manufacturing that particular bread, he needs some profit, right? He needs some profit. So, in case of incorporated companies, like registered companies, we call it as a operating surplus. Well, in case of the other companies, like unincorporated companies, we call it as a mixed income. To put it simply in a layman language for you, profit or operating surplus or mixed income. Operating surplus or mixed income. What is this operating surplus and mixed income? To put it in a layman language, it is nothing but a profit that a manufacturer want for manufacturing his bread. Right? We use these two important terms, operating surplus and mixed income, in case of an incorporated company which is registered. Incorporated company means registered company which have a formal transactions, and we use this term instead of profit, we use the term mixed income for the same definition, but for unincorporated companies, those companies which are not registered, like family businesses. You do all know that the family businesses also produces this kind of a bread. If they add 20 rupees of profit to it, see, let us try to understand it as 20 rupees. If they add 20 rupees of profit to it, we call it as a mixed income. That is as simple as that. Simple. The profit that needed by an incorporated company is called as operating surplus. A profit added by an unincorporated company is nothing but operating surplus. Simple. Next. Now, consumption of fixed capital. Guys, we all know in order to manufacture that bread in that particular manufacturing company, that producer need to use machinery. This machinery will go wear and tear. Wear and tear means you know the meaning of it. After a period of time, the machine's lifespan will get completed and they need to replace it. So for example, the machinery which is used by the manufacturer in the manufacturing company have a lifespan of 10 years. 10 years. Now, the machinery cost is 10 lakh after 10 years. Imagine a statistician estimated that the price of that particular machinery after 10 years is 10 lakh. Now, he also said that the manufacturer need to charge at least 10 rupees on every bread so that he accumulates 10 lakh rupees after 10 years period of time. So on one bread, he needs to accumulate 10 rupees and after 10 years, the total amount will get to an average of 10 lakh rupees. Right? So this will also be charged by the manufacturer. That is 10 rupees. That is 10 rupees. See, this 10 rupees is not a profit for the manufacturer. He needs to use that money, he needs to store that money, and he needs to spend that money in order to replace the machinery after a period of time. So remember, consumption of fixed capital is not considered as a profit. This is only the amount that he receives as a profit. Next, the fourth important component is production taxes. Now you know that the manufacturer, in order to register his company, right, he needs to pay a registration fee, he needs to pay stamp duty, right, he needs to pay like a labor fee. In such a way, the manufacturer needs to pay different kinds of fees to the government, irrespective of whether the manufacturer produces the goods in the company or not. He needs to pay these kind of production taxes to the government. Of course, it will be also a part of production, right? So he will add it. So cumulatively, we got 50 rupees. We got 50 rupees. So in such a way, the manufacturer have added 50 rupees value to the inputs that he have taken, that is 30 rupees, and ultimately made the price of the output value as 80 rupees. This is how the value addition will be done. The name itself is suggesting it's a value addition done by the manufacturer to the inputs that he have taken. I hope it is very clear. This is the meaning of value addition. Now let us try to understand that this manufacturer have produced it at 80 rupees. Now you all know that often we eat this kind of a bread in our bakeries. Now imagine this is a bakery. Now you all know that this bread is currently priced at 80 rupees. Now comes the important thing you need to observe very important. Earlier there used to be a tax called VAT, value added tax. Now the current GST is nothing but a value added tax which is imposed all over the country. It is often said that GST is nothing but a single VAT for the whole country. Like the way in which, now just we are going to discuss the features of the VAT also, like the way in which the value addition tax acted in the state, it is the same way the GST is going to act all over the country. So the VAT, the procedures, the way in which the tax is collected on the goods in the VAT system is the similar system that the way in which the GST is currently being collected. Right? I hope it is very clear. Now if this bread comes to the bakery, now this bakery person, see, I already said you that in Asia we do have different kinds of taxes, indirect tax. Now what this person is going to do is, see, for purchasing this bread, this 80 rupees bread came to the bakery. Now he is the consumer. Often he might get fell sick. You know that often these days when we fell sick, we often eat the soft foods like this bread, which can be easily digested in our digestive system. So this guy fell sick and he went to this particular bakery to buy the bread. Now this manufacturer said that the bread is 80 rupees and you need to pay a tax, a VAT, value added tax of 10% on it. You need to pay a value added tax of 10%. Now tell me, does the tax will be collected on the whole 80 rupees or tax will be collected on value added? Here see, what is the value added here? The manufacturer added the value of just 50 rupees only. When the tax says, see, the name itself suggesting it's a value added tax, a tax which is imposed on the value added but not on the whole price of the bread. So what is the value added amount in this particular bread? It is nothing but 50 rupees. Value added in this particular bread is 50 rupees, right? So when the VAT is 10%, it is nothing but 10% of the 50 rupees. So 10% of the 50 rupees is nothing but 5 rupees. So ultimately this person buys that bread at 85 rupees. Ultimately this person buys the bread at 85 rupees. Because it is a value added tax, a tax which is levied on the value added only. The value added is 50 rupees. In our example, the manufacturer took an input of 30 rupees and added a value of 50 to it. So value added is 50, and when the value added tax is 10%, that is nothing but 10% on the value added 50 rupees. So 10% of the 50 rupees is 5 rupees. So ultimately made the price of the bread at 85 rupees. 85 rupees, right? Similarly, it is called, so see, this is nothing but GVA at market prices, the gross value added at market prices, right? Ultimately the gross value added at market prices ultimately is 55 rupees. Taken the inputs of 30 rupees and added a value of 55 at the market prices, and ultimately made the price of the bread to 85 rupees for the ultimate consumer. So this 10% here is nothing but GST. The 10% now, this VAT, here I used the term VAT. Now instead of VAT, as I said, this VAT is nothing but a single GST. See, the GST is nothing but a single VAT which is imposed all over the country. Now understand the same situation. Now this person goes to this particular bread shop and he wants to buy a bread at 80 rupees and ultimately he pays 85 rupees. The tax is 10%, GST is 10%. So GST is 10% means 2.5 rupees, 2.5 rupees of CGST and 2.5 rupees of SGST. So in such a way, totally 5 rupees, which is nothing but 10% of the value added. Right? I hope it is very clear for you. Like the way in which this VAT worked, here VAT is 10%. Now instead of VAT, we are using the term GST. GST is 10%. GST is 10% means GST is a dual tax. That means we have the two component of it, CGST, SGST. So CGST is 5%, SGST is 5%. 5% is nothing but 2.5 rupee and 5% is 2.5 rupee, ultimately 5 rupees. So the bread is sold to the ultimate consumer at 85 rupees. This is how the GST is currently being working in all over the country. Right? I hope the thing is very clear for you right now. See, now let us try to understand the important features of this GST. See, now earlier what is the case? Now this is how the GST is working. Now earlier case is, see, the price of the bread is here 80 rupees. When the tax is imposed, earlier the tax is imposed, the whole value of the bread, say for example 10% of 80 rupees. So the bread price is 88. The price of the bread for the consumer earlier is 88 rupees. Now it is just 85 rupees for the ultimate consumer. In such a way, after the implementation of the GST, the prices got rationalized. Right, guys, here the 10% is the sales tax. For example, the sales tax. Not only sales tax, guys. Earlier there used to be a different tax like octroi, entry tax, which is 5%, 2%. Ultimately, all these kind of indirect taxes being imposed on the same good, which is causing a cascading effect. Tax on tax is nothing but cascading effect and ultimately increasing the price of the goods to a higher range. So, say for example, here the good by imposing 10% of the tax became 88 rupees. Right? Now, ultimately, for example, if the entry tax is again imposed as 10%, so 88 means 8.8 rupees. So, 96.8 rupees. In such a way, different kinds of indirect taxes is being imposed on the same good, ultimately increasing. See, here already 8 rupees is the tax. Now ultimately again 10% of the tax is being imposed. So ultimately the tax became, the price of the bread became 96.8 rupees. In such a way, tax on tax is being imposed by creating, so thereby having a cascading effect and increasing the prices of the goods to an exponential level. But after implementing GST, this is the scenario. Instead of paying 96 rupees for a bread, now we are paying 85 rupees. This is the one of the important advantages. So now let us try to answer. So I hope it is very clear for you what is the basic difference between a direct tax and indirect tax and how the GST works also, right? Now let us try to look at some of the important features of the GST. As GST is aimed at integrating the indirect taxes of both the center and states into a single national tax, popularly known as single VAT of India. Just now I have told you how the VAT works. Now we are calling the GST as a single VAT of India. I hope it is very clear for you right now. Now, it is to be collected on the VAT method, like the way in which the VAT was collected. Just now I have given you an example on how the VAT is being imposed. Similarly, the tax is being imposed. Earlier the VAT is 10%, now GST is 10%, right? I hope it is very clear for you. It is being imposed at pan-India level with uniformity in the tax and 4 taxes of the center. Now we are going to look at the different kinds of central taxes and state taxes which are amalgamated into the GST. Now you need to remember, in India, GST bill was first introduced in 2014 as a constitutional amendment bill of 122, but it passed as a constitutional amendment act of 101. Guys, see 101, 102, 103, in such a way the government is going to propose different kinds of constitutional amendment bills, but which got the approval first will become an act. So automatically the bill, constitutional amendment bill, and the same constitutional amendment act would not be the same. See, it is 122nd amendment bill. So but there might be 101 constitutional amendment bill, 105 constitutional amendment bill, 110 constitutional amendment bill. These are not approved in the parliament. So before all that, 122nd one was approved. So we got the 101 constitutional amendment act of 2016. You need to remember, and there should be very clarity with respect to it. So as I said, the GST is a value added tax levied on most goods and services for the domestic consumption in the country, right? The GST is paid by the consumers. See, GST has subsumed almost all domestic indirect taxes. I hope you understood the meaning of indirect taxes. But there is exceptions. Except alcoholic liquor for the human consumption, 5 petroleum products, petroleum crude, motor spirit, it is nothing but petrol, speed diesel, natural gas and aviation turbine fuel, stamp duty, right? All these are being exempted. Now, when I say these are being exempted from the GST, what does it mean? They are not being taxed. That does not mean they are not taxed. They are taxed with the older method, like sales tax, state VAT, all these kind of older taxation method of the goods is being imposed on these particular goods, exempted goods. So you can have a list of all those central taxes which is being subsumed into the GST here, and you can have a look at all those state taxes which are being imposed, which are being subsumed into the GST here. So have a note of it clearly. So like state VAT, central sales tax, luxury tax, entry tax, octroi in such a way, octroi is an entry tax. In such a way, we have different kinds of indirect taxes which are being completely subsumed into the GST, both central as well as state taxes. See, in this bill you can see the example clearly. Here, simple. The tax is levied on value added. Earlier we have the service charges of 10%, the food taxable VAT. See VAT. See, service chargeable VAT. So in such a way the VAT is being imposed earlier. Guys, you observe the service charge of 10% in the bills these days. This is not a tax. Service charge of 10%, which you often see in your restaurant bills, is not any kind of a tax. It is being collected by the restaurant itself. It is not being paid to the government. So service charge of 10% is not a tax. So you have to be very conscious with respect to it. Applicable on supply side. These are the features of the GST. GST is applicable on supply of the goods and services as against the old concept of production of goods, right? It is a destination based taxation. What is the meaning of destination based taxation? See, for example, in the Kerala, a good is produced and it is being transported to the state of Odisha. Now here, see guys, imagine the tax rate is 100 rupees on that particular good. So 50 rupees will be collected by the central government. As you know, the CGST and SGST are the two important components of the GST. It's a dual tax, and 50 rupees is given to the state in which ultimately the good is being consumed. If the good is being consumed in Odisha, the central government will give it to the Odisha, right? See, and if the good is being consumed in the state of Andhra Pradesh, the central government is going to pay the tax to the Andhra Pradesh. So in such a way, it's a destination based taxation on which state the good is being consumed. That state GST component is given to this. You need to remember, under the GST regime, the interstate of goods and services are being imposed with a taxation of IGST. IGST is nothing but CGST and SGST. Now imagine a good is taxed with an IGST of 100 rupees. In this 100 rupees of IGST, as I said, it had two components. We have CGST and SGST of 50 rupees and 50 rupees. Total 100 rupees will be taken initially by the central government, and then the central government will keep 50 rupees of it with itself, and it will wait on ultimately on which state the particular consumable good is being consumed. But that particular state, the central government is going to transfer the rest of the 50 rupees component. In such a way, it's a destination based tax. As I said, it's a dual GST with the center and state simultaneously levying the tax on the common tax base. Now, why? See, the central government has the economic jurisdiction all over the country. So wherever the good is being sold, the central government has the jurisdiction to impose the tax. So in such a way, in whichever state that the goods is produced and sold, CGST is must. Now, see, the central government gets the CGST tax under it. Now, for example, if a good is being produced in the state of Tamil Nadu and the SGST, and it is also being consumed in the state of Tamil Nadu, the SGST component is only being got by the particular state. So in such a way, if at all the good is sold and produced in Karnataka, Tamil Nadu, Andhra Pradesh, CGST will be given to the central government, because the central government have a jurisdiction all over the country and the state government has economic jurisdiction within their territory. So SGST is given if at all the goods is being consumed in that particular state. I hope it is very clear. Next. Import of goods and services are treated as this IGST in the GST regime. Say for example, if at all this good is being imported from any other country to the India. The tax which is being levied on it is IGST, is nothing but CGST plus SGST. Now you need to remember, apart from IGST, the customs duties which is imposed on the goods and services at the international borders is still being continued. It is not being subsumed into the GST. So be very cautious. So now, earlier in the bread, the tax is 10%. Earlier tax is 10%. Now, on different kinds of goods, the GST is at different rates. Like for example, on some goods, the tax is 5%. Is for some goods, the tax is 12%. And for some goods, the tax is 18%. And some for goods, the tax is 28%. In our bread, it is 10%. Right? Next, all these taxes, like for example, on which good how much percentage of the tax need to be levied will be decided by the GST Council. See, the CGST, SGST and IGST are levied at that rates only after it was mutually agreed upon by the center and state. Such rates are notified on the recommendations of the GST Council. You should be very careful it, right? See, like on the milk, this is 0% tax, completely exemption from the GST. Like sugar, spices, 5% tax. Bread, for example, 10% in our example, 12% on the computers and food process. Like the way in which the tax is being levied on the bread, these 12% and 5% and 18% is also levied in the same way. See, on the luxury items, 28%, right? See, next, the schedule or the list of the items that would fall under these multiple slabs are worked out by the GST. Which good falls under the which slab of 5%, 12%, 18% of the GST will be worked out by the GST Council, right? Next, see, threshold limit for the exemption from the levy of GST would be 20 lakh for any businesses in the normal states and 10 lakh in the special category states. See, the states also going to get a compensation for the 5 years for loss of revenue due to the implementation of the GST, right? The central government, right after the implementation of the GST, it have created a GST Compensation Fund. Now, GST compensation cess is being levied on the demerit goods like alcoholic products and these kind of goods. The GST cess, you know the meaning of cess? Cess is nothing but a tax on tax. Say for example, this is a good, the tax is 10% on it. So totally it becomes 110 rupees. If cess is 10% again, what is the 10% here? 10 rupees. What is 10% of this 10 rupees here? 1 rupee. So ultimately 1 round rupees will be collected in such a way that 1 rupee is nothing but cess. So in such a way, GST compensation cess will be levied on demerit goods, and that amount, that collected amount will be subjected to the GST Compensation Fund. And right after this 2015 and 16, the state's growth rate will be assumed as 14%, and right, whatever the losses that are acquired by the implementation of the GST for the state government, the amount, the balance amount will be given out of the GST Compensation Fund. Say for example, imagine without implementation of the GST, the states might get 100 rupees because you know before the implementation of the GST there are different kinds of indirect taxes like octroi, these kind of indirect taxes. Due to earlier, the state used to levy these taxes so that the states got a lot of revenue. Now these are being subsumed into the GST. So as a result of it, how would the state would get the taxes? So the central government decided that as the states is going to get accrued losses with respect to implementation of the GST, so we would compensate that loss amount. How would the central government will compensate? In such a way, a GST compensation fund will be created, a GST compensation cess will be imposed on the demerit goods and it is subjected to the fund. And now, if the growth rate is imagined at 14% for a particular year, for a particular state. Say for example, the state of Tamil Nadu has imagined a growth rate of 14%, and with that growth rate, without the GST being implemented, the state might collect 100 rupees. Now after the implementation of the GST, many indirect taxes is subsumed. So as a result of it, 80 rupees is the only amount collected by that particular state. Now rest of the 20 rupees, next of the 20 rupees will be given to that particular state out of the GST compensation fund. It is as simple as that, right? Next, we have the GST Council. As I said, it is going to be chaired by the Union Finance Minister. It is going to look at all those issues of the GST. Next, exemptions. As I said, petroleum products, all these are exempted from the GST, and we have the advantages. GST mainly removed the cascading effect on the sale of the goods and services. Like I said, the price of the bread became 96 rupees, and after implementation of the GST, it became 85 rupees. In such a way, cascading effect is removed. Single GST regime eliminate all the taxes. I would say single GST regime. Still, there are a lot of products which are being still levied. A tax is collected in the old methods only, right? All the activities like registration, written filing, all will be done through the GST portal. Next, see, These are the issues with GST. High operational cost. GST has given complexity for the many business across the nations. Now, the petrol is not under the GST, which got against the ideals of unification of commodities. You know that the petrol prices will vary from one state to other state, because if it is under the GST, the price would be same all over the country. Because the petroleum products are not brought under the GST, the states will impose their own according to their own taxes, right? So that's the reason why the petrol prices will vary from one state to the other state. I hope it is very clear. Now, when we look at the receipts to the government under the GST, see, customs is about 5% of the total receipts received by the government. Corporate tax is 28.1%. Personal income tax is 16%. Excise. Corporate tax is a tax paid by the corporates. It's like a personal income tax. If an income tax is paid by the person, we call it as personal income tax. If the same income tax is paid by the company, corporates, we call it as corporate tax. But because out of the total revenue, the government is going to get, see, this kind of a revenue from the corporates at a higher level, so they put it under separate head. See, both these are nothing but direct income taxes. But the corporates is going to contribute more to the government's income revenue, corporate tax. So as a result, the government put it under a separate head. That's the reason. Now the GST, see, the corporate tax is just approaching similar to the GST. Earlier, what actually should happen is the GST should be very much larger, very much higher, right? So in such a way, the share of taxes in the government receipts, we can see here. So this is all about GST. And guys, in our courses, we have completely discussed in a detail classes about this GST implementation, various initiatives for the effective implementation of GST in a broad manner. But in this class, I hope it is very clear you have understood the basics of the GST, its implementation and its features very clearly. I hope it is very clear, right? Now let us move on to the next topic. Now, a fiscal deficit stood at 58.9% target in January 2022. Now, what is the meaning of fiscal deficit? You know that the government will receive a revenue and the government will also make some kind of an expenditure. If expenditure is more than the revenue, we usually call it as a deficit. To put it in a layman language for you, what is a deficit, guys? Deficit is something we want but we don't have it. In terms of economy, deficit simply means we want some money but we don't have it. Like for example, if in the budget we need to spend 100 rupees, but we only have 97 rupees, but we only got 97 rupees, the 3 rupees is nothing but a deficit. We call it as a budget deficit. Now, in case of fiscal deficit, it simply means the difference between total expenditure and total receipts other than borrowings and other liabilities. See guys, liability means I am liable to pay you something. Say for example, if I am a state government, the central government will act as a guarantor for me and it is going to provide me with a loan. These kind of things will also be acting as a liabilities for the government. Say for example, the central government took a loan of 100 rupees, we consider it as a borrowing. And the central government, what the central government did was, central government acted as a guarantor to the state government and the central government made that agencies, any other agencies, lending agencies, to give 50 rupees to the state government. The simple meaning, central government will act as a guarantor, so you give the loan to the state government. In such a way, it acted as a guarantor and made the state governments to get a loan of 50 rupees. Now this is the direct borrowing amount. Now it is as a liability. So totally 150 rupees is the liabilities. 150 rupees is the total liabilities. So in such a way, it is simply the difference between the total expenditure and total receipts. To put it very simply for you, don't get confused and clumsier. To put it very simply, fiscal deficit is nothing but the borrowings of that government in a particular year at the end of the year. Say for example, if the government got a receipt of 100 rupees, the government want to make an expenditure of 100 rupees. Now it only got an amount of 97 rupees. Now what is the balance here? 3 rupees. What is 3 rupees? Now at any given period of time, the budget deficits would be zero. The government is going to borrow that money of 3 rupees from both internal sources as well as external sources, particularly 90% of the borrowing from the internal sources. So that borrowed money is nothing but fiscal deficit of that particular year. Simple. The amount that is borrowed in a particular financial year by the government is called fiscal deficit. Right? I hope it is very clear for you. Now, what are the instruments of internal borrowing and external borrowing? We have discussed very clearly in our classes, as well as we also discussed it in our economic survey classes, right? Next. Revenue, this rupee slips on oil to 11-week low past 76 per dollar. Right guys. Now you need to understand here the meaning of exchange rate, what is the meaning of depreciation, what is the meaning of appreciation. Now here see, in our example $1 is equal to 75 rupees. Imagine guys, imagine here $1 is equal to 75 rupees. Now we all know that 80% of the crude oil in the country is being imported from the other countries. Here imagine a situation, now all of a sudden due to any kind of a war, the supplies of this crude oil is being reduced, as we seen in the Gulf War of 1991. If the crude oil supplies is reduced, then automatically the price of this particular crude oil is going to get increased. Now we all know that we do international trade in dollars. Most of the countries do the international trade in dollars. Now see, in order to buy the barrels of the crude oil, say for example, for our understanding, try to consider this $1 as a commodity. We all know if something is demanded more, its price increases. If something is demanded more, its price increases. It is a simple demand and supply theory. Now, in order to purchase more and more crude oil, you know that supply is reduced due to the war. We need to purchase more crude oil because 80% of is being imported from the other countries. In order to purchase that crude oil from the other countries, we need more and more dollars because the prices of this particular crude oil is increased due to the war. So in order to cope up with the increased price, we need more dollars. Earlier, imagine, for example, if 1 barrel of the crude oil is $50. Now imagine due to the war, the barrel of the crude oil increased to 80 rupees. Now we need extra $30. How can we get the extra $30? We need to convert our rupees with the dollars. Now in order to convert our rupee with the dollars, what we are going to do? We are going to demand more and more dollars. As per demand and supply theory, if the dollar is demanded more, its value increases. So what is the meaning of increasing the value? So $1 is equal to 75 earlier, it might get increased to 85 rupees. So in such a way, if on the basis of the market and supply forces, if the exchange rate increases from 75 to 85, we call it as a depreciation. The reverse is the case. If the demand for the dollar falls down, the exchange rate automatically decreases. Now the exchange rate is 75 rupees. If the exchange rate decreases to 70 rupees, this is called decrease in the exchange rate. We call it as appreciation. If the same thing is done by the governments or by the central banks deliberately, we call it as a devaluation or revaluation. Devaluation means if the dollar to rupee ratio, the exchange rate of the dollar to rupee ratio is decreased, we call it as a devaluation. And if the dollar to rupee ratio, the exchange rate, is being increased by the central government or the central bank deliberately with an actions, we call it as revaluation, which is often seen in the case of Chinese central banks. Right? This is the meaning of this rupee appreciation and depreciation. See, depreciation and appreciation takes place automatically due to the movement in the demand and supply of the currencies in the market, whereas a devaluation and revaluation are done voluntarily either by the government or a monetary authority like RBI. Right? Next, the last topic we have is SWIFT. Yes, these days this SWIFT is often came into news. Right? Guys, recently Russia have attacked the Ukraine. We all know about it. We have been listening to our classes. We have been listening to this current affairs in our newspaper analysis also. We do not to discuss all these things, but you may have already a good awareness with respect to it. As far as the SWIFT is concerned, it's like a messaging. It's not a open message code. It's like an encrypted code which is being utilized in the international financial transactions. Many countries and many institutions have been attached or linked to this kind of a SWIFT network. Right? It is headquartered at Belgium and connects more than 11,000 banking and securities organizations over 200 territories. Right? SWIFT is merely a platform that sends messages and does not hold any securities or money. You need to be very careful with respect to these kind of points. UPSC often tests these kind of points. Right? Now, each participant on the platform is assigned a unique 8-digit SWIFT code or a bank identification code. This is the way in which SWIFT is going to work. If a person, say in the New York with the Citibank account, wants to send the money to someone in the HSBC account in London, the payee would have to submit his bank, the London bank, that is London bank based beneficiary, the account number along with the 8-digit SWIFT code for the particular receiving bank. The Citibank would then send a SWIFT message to the HSBC, which is very encrypted. Once that is received and approved, the money would be credited and required account. Now, why it came into news? What would be the effect? Earlier, the country of Iran was removed out of the SWIFT. Now, the Russia was removed out of the SWIFT. Right? In order to have some alternatives with respect to the SWIFT, so Russia is having its actions. Of course, it will do it. Then, see guys, now it is believed all over the world that if a country is removed out of the SWIFT, delisted out of the SWIFT, it is going to have a lot of economic repercussions, which is seen in case of Iran. The world believes that the same kind of economic repercussions can be seen in case of Russia also. Now, you know that these days, the war can also be won with the economy. Wars can also be won with the economy. It is in fact considered as a nuclear weapon in the economy with respect to these wars. Right? So, these kind of facilities with respect to the international transactions. See guys, in order to have a crude oil transactions, in order to sell their weaponry, all these comes under the financial transactions, which will be done by the Russia. It will be very easy for them if they are a part of SWIFT. If they are not a part of SWIFT, international transactions, selling the crude oils and petroleum reserves and selling their weapons to the other countries and receiving the money will become very difficult. When these things happens, then automatically the Russian economy will be crippled, so that they will stop the war. This might be some kind of a strategy, right? This might be some kind of strategy and altogether a different topic. So, this is all about the SWIFT and how it is going to work. So, here you can see the governance organization, which is not very much important, but this is very much important for us, right? It does not hold any kind of a securities. So, this is a participant country is going to have some advantages, and those countries which is remote, international transactions will get affected. So, this is all about these week's current affairs, and the rest of the ancillary current affairs is already covered in your economic newspaper analysis by our Rathods IAS. So, these are the major things which you need, both the analysis of the static part as well as the rest of the current affairs. So, I hope you understood what is about this GST appreciation deficits and as well as this SWIFT. I hope you understood and enjoyed this class. Thank you and stay tuned to Rathods IAS.